Rick, fold in the negative rates conversation into the world of equities. Do you assume the reallocation from bonds to equities, given dividend yields now look more attractive than Treasury yields?
Well, we've had a few years now where we've been overweight in equities relative to those safe havens, and we've reversed that quite recently to be underweight in equities. If you look at the valuation metrics against negative yields, often they look pretty attractive, but what you've got to keep in mind in equities is you want growth, or you need growth. You need earnings growth, you need dividends growth. And as we see that dissipating because of the bad soft data and now the bad hard data, we're concerned that we're not getting rewarded for taking equity risk.
Are you worried within that equity risk about the bottom line, or is there margins or sectors where you're not seeing margins as pressured perhaps as others?
Well, the consumer, I mean, there's the apocryphal consumer in the US, very strong at the moment. But as Williams related yesterday, we can't always rely on the consumer, but that's the only thing left. And I think that's driving a lot of the valuations in US equities. And we're cautious about those overvalued consumer parts of the market. If we're going to go anywhere, we're going to look for value. That leads you to industrials, to energy, a little bit of tech we find interesting, but overall we're underweight in equities.
Where and when does the next recession start? Is it in 12 months? Is it 18 months? And is it because chief executives don't want to invest because they're so uncertain about what the future holds?
I think there's no inevitability about a recession. This slowdown, which may turn into a recession, is at least partly driven by US-China trade dispute dragging on. If that was resolved, or partly resolved later this year, it'd be too late to save 2019, but it certainly might prevent a recession in 2020.
But even if there is a resolution, how can you be so sure that it doesn't collapse 2 months after that, right? We've had this tit for tat, like, oh, we're close to a deal, we have a deal, oh no, actually they messed up on this count. And so, how can you be sure that it holds, basically, if you have a deal?
Well, you can't be certain it holds. And I guess the US-Mexico-Canada agreement has held with a few bumps in the road. I think if people are putting their reputation on the line for signing up to a deal, I think it'll stick. That's not to say there won't be kind of noise around it from time to time.
Where would a shock come from if there was something? Could Brexit be a shock for the global economy, or is it too small and domestic?
Well, we're experiencing a shock. We got the shock of tariffs, and we've got the shock of business confidence in emerging markets and in China. Brexit could be the thing that tips us a little bit further, but the shock's already apparent. Look at the German data. That's the function of that shock.